I don't think you need a reminder that if you're going to turn in your valuation sometime soon. No, I know there's a Friday. It's not really a drop dead deadline. So if you're somewhere in the next week, if you can get it to me. Yeah. But Friday would be nice, or today would be nice, or tomorrow would be nice. I have about 50 of your valuations back already. There's one thing though I do want to kind of point to. It might not be relevant for you, but sometimes you're in a business where the economics are changing. Right? Take computer chips, right? It costs about 1/10 what it used to produce a chip than it did 10 years ago. And your first reaction is, if I'm in a business where the costs of making something are dropping, my margins should go up. But here in the computer chip business, the costs have dropped, but the margins have also, they've at best stayed stable. So why? Why, when your cost structure is changing, do you not benefit with higher margins? If everyone has it, no one has it. I know it sounds mysterious, but I'm saying if you're seeing something that's happening that's sector-wide, it's not a story you can tell for your company making higher margins, because what effectively happens is everybody's costs come down, and guess what happens? Prices drop because you're in a competitive marketplace. So whenever you tell a story about a company and you're making it the basis for changing something, changing growth, changing margins, the question you always have to follow up with is there something unique about my company on this story? So be careful not to tell global stories or sector-wide stories that somehow make your company magically more profitable. Because I've seen equity research analysts do it, pick their company, this is going to be amazing for my company. And 5 years later, you look at the company and there's nothing amazing happening in that company. So if everybody has it, nobody has it. It's actually been my pushback against this big data thing that's gone out of control, right? The last decade, everybody wants big data. It's amazing. We have big data. We have your location. Guess what? 26 other apps have my location too. Everybody in the world knows where I am if they want to track me. You think you're special? I remember when you remember, I don't know whether you live in a part of the country where you have Lime scooters and you know the kind of apps where you can get on a scooter. I remember the business came in and I can't for the life of me figure out the economics of this business. Because I'll tell you what happens in San Diego where I live. About a quarter of the scooters end up in the ocean because teenagers with nothing to do, I'm not kidding, will take the scooters, environmentally awful, they throw them off the cliffs into the ocean. Yes, so how does a business make money charging what, $1.50 per hour and your a quarter of your scooters are disappearing? So I talked to somebody who had invested in this business. I said, why do you do it? And he said, big data. And I said, what? He said, we can track where you're going on the scooter. I said, welcome to the club. So what are you going to do with that data? He hadn't thought through that. But this is the problem with platform plus big data driving big numbers. if you don't think to how do you monetize it. Big data is valuable when it's exclusive. What makes Netflix big data? What's the big data that Netflix has? When you turn on Netflix, it's kind of creepy, right? They know everything you've watched. They also know everything you stopped watching after halfway through. So it leaves that arrow where you've left off. They've collected data on everything you watch, everything you don't watch. And guess how they use it? It's exclusive. Netflix alone has the data. They're a big content maker now, right? Have you noticed that they keep producing the same kind of show over and over because you like the show? I'm on the string of like Bad Vegan I'm watching now. I'm just addicted to these stories about people who go off the racks when it looks like they're successful. But you notice that the same kind of show keeps hitting you. They say, you like these 10 shows? If you're going to tell a story and it's not exclusive, it's very difficult to convert or monetize that story. So today we're going to talk a lot about different kinds of companies to value. So let's start with a few pre-class tests. One of the things we're going to talk about today are emerging market companies. Many emerging market companies, corporate governance is not just weak, it's dead. I mean, forget about emerging market companies. You buy shares in Facebook or Google, you're already giving up corporate governance because you have two classes of voting shares. But with emerging market companies in particular, there is this tendency on the part of analysts to say, I've valued the company, I've done a DCF value, but now I'm going to attach a discount to that value because corporate governance at this company is bad. Logic makes sense, right? Having bad corporate governance is bad. So is it okay to apply a discount to your DCF because of that? Anybody want to give that a shot? In fact, you did the DCF, right? So I'm going to turn back and say, when you did your DCF, did you factor in how the companies run? What's the essence of, I mean, we make corporate governance into scores and all this neat stuff, but what's the essence of corporate governance? Is when companies get run badly, you can change the way they run, right? If you boil it down to basics, that's what corporate governance is. So let's say you have two badly managed companies. One has strong corporate governance, or is in a system where there's strong corporate governance, and the other has weak or non-existent corporate governance. Now, when you do a DCF, you make assumptions about the future, what will happen to margins and growth and returns and capital. So if you have a badly managed company, what do we do on spreadsheets? We fix them. Think of how easily we fix them. We'll make the margin into industry averages. We'll make sure the return on capital at least goes back to the cost of capital, and we value the company. We're in a sense assuming that bad things get fixed. And if you have strong corporate governance, that's not an unreasonable assumption, right? Because those companies will probably see their managers challenged and perhaps replaced. And the change that you're forecasting in the spreadsheet will happen. But let's say you're looking at a company that's badly managed. It's a family run. Badly managed doesn't mean they're losing money, right? They're just making money, but they're not making enough given how much they've invested. It's a family run company. And there's zero chance of you changing the way it's run. You know what you should do in your DCF, right? You have margins that are terrible, leave them at terrible values. Because the current management doesn't seem to think of that as a problem. If your returns on capital are below the cost of capital, leave them below the cost of capital, not just for the next year, not just for the next 5 years, but perhaps in perpetuity. This company is a value-destroying machine, and nothing is going to get in its way. If you do DCF right, there's no need to adjust for corporate governance. It's trickier when you have a well-managed company with bad corporate governance, right? Because there you worry that you built in good stuff, but if things go bad, you're now stuck with bad stuff and you can't do it. It's a challenge I've faced in valuing Facebook for the last decade. I think Facebook as a business is an incredible machine in terms of generating profits. Margins are close to 50%. And when I value Facebook, I'm putting in those high margins. Perhaps competition might reduce the margins. But let's face it, in Facebook, you have zero power to change the way the companies run because Mark Zuckerberg owns 57% of the voting shares. So my worry with well-managed companies with bad corporate governance is perhaps you're putting yourself in a trap, because today's well-managed company could become tomorrow's badly managed companies. There you might have to work a little harder in your terminal value calculations to bring that in. But if you do things right, it should already be incorporated in the value. This is an aside. Remember all the dance we did about converting R&D from operating to capital expenses? Huge pain in the neck, right? Because you'd redo the financials. Change our margins, change our reinvestment. It didn't change the bottom line free cash flows in the most recent year, but it changed the way we thought about the company. Let's say I take a pharmaceutical company. I value it using traditional accounting, where R&D is expense. And then I capitalize R&D, and I revalue the company. What is going to happen to the value per share that I get for the company? And I'll give you the choices. It'll remain unchanged. If this were the answer, why would we ever capitalize R&D, right? So clearly, A can't be the answer. So the real question is, will value go up? Will value go down? Or is it difficult to tell until you've looked at something else? We're going to do this in Amgen, so you can give me a preview. Will value go up, value go down, or will it depend on the R&D? Why do we capitalize R&D? To treat it like any other project, right? Can projects be good? Yeah. Can projects be bad? Yes. Can R&D be good? Yes. R&D can be bad. Yesterday, I was reading a statement from Mark Warner, senator from Virginia. And you shouldn't really expect senators from either party to make sense on anything related to companies or markets. But he was talking about this new buyback proposal that is in the works. Have you read about this? That companies that do buybacks, they'll do a clawback. But the bottom line is, I mean, we can talk about executive making money on buybacks. I completely agree. We've got to shut up. But the basic notion is buybacks are bad. So Mark Warner was talking about why buybacks are bad. He said these companies that are doing buybacks should all be putting that money into R&D. Let me ask you a question. Do you want United Airlines to be doing a lot of R&D? Do you want Merck to be doing a lot of R&D? Given the quality of their R&D, the notion seems to be R&D has to be good, but that's not true. Companies have invested in R&D and they've been terrible investments, and companies that do good R&D. So when you capitalize R&D, that's what you're measuring. Does this company do R&D well in terms of creating value for itself? Remember, you're not a research institute, you're a commercial enterprise. You're judged based on whether your R&D pays off. So we're going to look at how this plays out when you look at companies. One final point. So the answer to the previous one is it could go up, it could go down. For Amgen, it does go up, but when I capitalize R&D at Merck, the value per share actually decreased. Why? Because if your R&D is bad and I keep expecting you to continue to do R&D, you're actually going to destroy value as you keep doing this, not increase value. We're also going to talk about companies in trouble. So let's say you're valuing a distressed company with a lot of debt. Distressed in what sense? It's losing money. There's a very real chance it will not make it. So what you do is you make realistic assumptions about margins improving. So basically you say, look, if this company does this, and this margin will improve, you build in the improved margins. You have a high cost of capital to reflect the fact that your debt is very expensive. Now your ratings are terrible. And you come up with a value of $1 billion for the equity after you've done this all on your spreadsheet. Are you likely to overestimate? So you've done DCF right, the way we've all been taught to do DCF. Fix things, project cash flows out, and you get to a point in the future, what do? You see nirvana, right? Terminal value, put a big terminal value, discounted them all back. You see the catch in this process? When you do a traditional DCF, you will have good times and bad times, but you always roll through, right? And in this case, what have I set the problem up? There's a very real chance you will not make it. So when you do a DCF of a troubled company, you're probably going to overvalue the company, right? Because if you don't adjust for that distress in some other way, you can't do it through the discount rate. Discount rates cannot capture truncation risk, the risk that your company might not make it through next week. So we're going to talk about truncation risk and how to play it out, whether it's distress, nationalization, regime change. So all of these things that can happen, and overnight your equity is worth nothing. So lots on our agenda. Let's go back to the Amazon valuation that we were doing. So I left you with this page, right? I told you the story of how I got the revenue growth rate of 42%. And I'll be open. It's my story, my growth rate. You might have a very different judgment. I told you about how I moved margins from where they are today, minus 36.7 to plus 10. And I said, essentially, each year I'm moving half the distance to the goal. And there again, I said, you might have a very different view. If you feel that the pathway to profitability is going to be a lot more rocky, make it a quarter of the way, 10th of the way, and you will lose money for a longer period. There's one final point of this table that I want to point to. In year one, I expect Amazon to lose 373 million. So basically, if you look at year 1 and 2, there's no tax effect. For obvious reasons, if you're losing money, there's obviously no tax effect. In year 3, I make money, 407 million, but I still don't have a tax effect. Why? If I'm making money, am I not supposed to pay taxes? Yes. I've essentially tracked the losses, not just for the first 2 years, but in the losses I'd made all the way through. And what I effectively do is each time you make a profit, I check my NOL, and if there's an NOL, I use it to offset my taxes. In year 3, I'm fully protected. In fact, it spills over into year 4. That's why my tax rate in year 4 is lower, because I still have NOLs carried forward. This is the most effective way of dealing with NOLs, as opposed to what I've actually seen bankers value companies with NOLs. Well, they'll value the company, keeping the NOL to the side. And at the end of the process, they will take the NOL and multiply by the tax rate and say, that's my tax benefit from the NOL. There are 2 things you're missing when you do that. First is time, right? You're not going to get the tax benefit now. Here I've built in when you get the tax benefit. The other is this risk. What's the risk? If you never make money ever again, your NOL is never going to get you tax benefits. By bringing it into your cash flows and using the cost of capital to discount it, I'm capturing both the time value of money and the operating risk that I will not capture, that NOL. It's clean. It's in the process already. And that's why in the spreadsheet, I have that extra line item where I track your NOLs over time. So if you're building your own spreadsheet for a money-losing company, I'd strongly encourage that this is exactly what you do as well, is build in that NOL into your cash flows. So let's keep going. Often when you sit down to value young growth companies, you're tempted to use really long growth periods. Why are you feeling optimistic? The company's got this great pedigree. It's done really well. Remember, when you take these young growth companies, you're catching them often at the peak of their glory in terms of growth, right? They grow 80%, 100%. And you're tempted to say, hey, it's a high growth company. Let me use 25 years of growth, 20 years of growth, 30 years of growth. And if you've noticed, every single time I valued companies, I stop in year 10. And that always gets pushback from people who say, how come you're stopping in year 10? And then they start listing up companies that have grown for longer than 10 years. And you can name them as well, right? How about Microsoft? How about Apple? How about IBM in the 20th century? And I say, what does the fact that we can name these companies tell you about these companies? That they're exceptions, right? The reason I stop after year 10 is not because I'm saying no company can grow beyond year 10. It's because most companies don't grow 10 years. Forget about 10 years. In fact, one of the most depressing graphs I've ever seen about growth came from a study that looked at companies that have just gone public. So these are companies, remember, companies time going public when things are great. No company waits till so you've gone at the peak. So basically took those companies, compared the revenue growth rate at those companies to the revenue growth rate of the sectors they were in. So year 1, right after they go public, guess what you see? These companies have much higher revenue growth rate, 15% higher than the sector. It's great, high growth companies. 2 years later, that difference is down to 7%. 3 years later, it's down to 3%. By the time you get to year 5, you can't tell these companies apart from the sector. So let me make a general statement that I think is true across sectors. In most companies, growth doesn't last very long. The reason is simple, right? You're a young company, you're growing fast, you enter a sector, everybody notices you. That's the good news. And then what do? They try to come up with imitations. And unless you have strong barriers to entry, your growth dissipates very quickly. What I'm trying to say in a long-winded way is if you're valuing a young growth company, don't just get impressed with the growth rate. Ask yourself, what does this company have as a niche, as a competitive advantage that's going to allow them to keep growing at this rate? And if you can't think of any good reasons, then maybe you need to bring the growth rate down very, very quickly, because that's exactly what happens in the real world. I still remember when Groupon went public. Remember when Groupon went public, it came with this great fanfare of how growth was amazing. And it was amazing coming in. And I tried. When I sat down to value Groupon, I said, I'm impressed with the growth. But what does Groupon do that other people can't do? What is their competitive advantage? And you know what the only one that I thought of was? That they got my email address before than Amazon same day. I mean, like 15 other same day living social. If your only competitive advantage is you got people's email list first, it's not going to last long. And that's exactly what Groupon discovered. Their growth rate dissipated within a year or two because there was so much competition in the space. Yes. Spotify with a platform, what do they have that makes competition difficult? Why do you hold on to your Spotify account? I've tried to get my son to give up Spotify because I want to go to Apple Music. I got this free subscription and I'm paying this family subscription for Spotify, which is now at $15.99 a month. It's not cheap. He won't leave. What is it that keeps you stuck on Spotify if you've been there long enough? It knows you, you created song lists, you created, especially if you're a big user, you created this. This is exactly what every platform company tries. It's stickiness. And it's not permanent stickiness. Obviously, if Amazon Music gave me a great enough deal, and if they could figure out a way to transfer that would be amazing, right? We'll, convert your Spotify account, we'll convert your list in, but Spotify is going to put every barrier to it. So by itself, you're saying, what's so special about Spotify? They have the same music that everybody else. So how do streaming platforms set themselves aside? How did Netflix, when it started, was just sending movies? You could say anybody can do it. So what did they do to set themselves apart to keep their, 2013, I think, Orange is the New Black was their first original show. The advantage of original shows is you've got to be on Netflix to watch Bridgerton or whatever, Orange is the New Black. So with streaming platforms, watch for that. What is it? Because if you don't, you're absolutely right. It's a commodity and you're going to get wiped out. Now let's talk about reinvestment. Now with mature companies, the rule we had was if you want to grow, you need to reinvest. And there we made it explicit using that sustainable growth equation. What's your return on capital? What's your growth rate? Reinvestment rate. A lot of people in the value young companies seem to abandon that principle. They said it's a young company. Okay. It's true, I can't use the sustainable growth equation, but it's not true that I don't have to reinvest. The difference here is I've got to relate reinvestment not to operating income because that's not there yet, but to revenues. That's the basis for the sales to cap ratio. And remember, the higher this number, the more efficiently you're generating growth because that's $3 of revenues for every dollar of capital invested. So I'm going to talk a little bit about this because this is a number you'll be estimating for your company. It's probably the number that of all the inputs is the number where we have the least guidance on how to do it right. You can always look at the company's own past, right? Change in revenues, change in invested capital each year, come up with the sales cap from the past. Unfortunately, with young companies, that number is all over the place. You can look at industry averages. It tells you something about the capital intensity of the business. That's useful, especially if you're in established businesses. But here are a couple of things that can tweak the sales to capital ratio. 2 years ago, when I valued Tesla, the Shanghai plant had just come online. And when I projected the sales to capital ratio for the first 3 years, I set the sales to capital ratio at a high number, even though it's a fairly capital intense business. You know what I was reflecting, right? You have excess capacity. What does that mean? Your near-term growth you can get without reinvestment. So when you look at the sales to capital ratio and you're saying, what should it be? I've used one number here for all 10 because as a retail business, I don't see much change. But in some companies, especially if you have excess capacity, for the near term, you can have this really high sales to capital ratio, reflecting the fact that you can use capacity. How is that going to help you? It'll mean that for the first few years, you'll have relatively little reinvestment. But once you hit the capacity constraint, you got to think about steady state. So again, there's no easy answer here, but the sales to capital becomes the lever you use to talk about capital efficiency of the company. It's actually the variable that's going to separate Airbnb from a Hyatt or a Hilton, right? Two hospitality companies. The advantage of being an intermediary is you can get much more revenue for $1 of capital invested because you don't own the hotels, you don't buy the physical investment you got to make is much smaller. So in this case, I use the sales to capital ratio. Every year I take the change in revenue, divide by the sales to capital ratio. My reinvestment, that consolidated number, is basically what the company has to put back into the business. One of the challenges, though, when you value companies using my revenue growth, margin, sales to cap trifecta, is sometimes you can create companies that really can't exist in the real world. In other words, you're creating a fairy tale company because you don't have, while you're doing it, there's no check you can run, right? Am I making assumptions that are unrealistic? So I'm going to give you one simple check that's already built into the spreadsheet that many of you haven't looked at, and I'll explain how you could use it. When you reinvest in your free cash flow of the firm, you put in reinvestment, net capex, change in working capital. That reinvestment, if you think in balance sheet terms, is the increase in your invested capital that year. In other words, what you see as reinvestment is actually the delta in the invested capital. Put simply, if you reinvest nothing, your invested capital stays frozen. If you reinvest, your invested capital is rising. Here's what I did. I took Amazon's starting invested capital, which is tiny because it's a young growth company. And every year as I reinvested, I added that reinvestment on to get my invested capital for the next year. So each year, I'm building up to the invested capital by taking the reinvestment in that year. So 559 million plus 487 is 1,045. So every year. So in my spreadsheet, that's all I do. I take your reinvestment. So don't blame me for what's happening because I'm just taking your sales to cap, your reinvestment. I'm adding it to the invested capital to get the invested capital over time. You're saying, now what? I'm also projecting out operating income based on your margins, right? Remember, I have a projected margin. So I have my expected operating income from the income statement. If I take the after-tax operating income and divide by the invested capital, what do I get? I get a return on capital. Think of it as an imputed return on capital. You never actually explicitly assume a return on capital, but implicitly through your reinvestment and margin assumptions, you're estimating a future return on capital. So in the last column, I calculate based on your assumptions, what's happening to your company's return on capital over time. Saying, what do I do with that? Go to year 10. In year 10, I'm estimating a return on capital of 20.39% for Amazon. The question I needed to ask myself in 2000 was, am I comfortable with that number? And the answer in 2000 was, I can live with that. I can live with that. Why? T-bond rates were 6.5%. The return on capital at a typical brick and mortar retailer was 17 to 18%. I was assuming a slightly higher return on capital and strong competitive advantages because of the platform nature of the business. I said, I can live with 20%. You know what I couldn't have lived with? If that number had been 200.39%. What's my own spreadsheet telling me? You're not reinvesting enough, right? And if I'm listening, what do I need to go back and do? I need to go back to my sales to cap ratio. And if my return on capital is too high, I want to lower that ratio because I need to reinvest more. If you look at the very bottom line at the output page of your valuation, I actually compute your imputed returns on capital. And if you're getting 3-digit numbers there, there's a feedback loop that you're ignoring here because it's telling you something about the assumptions you're making about your sales to capital. Maybe you're not reinvesting enough. In contrast, if I ended up with 2.39% as my return on capital in year 10, Well, I'm reinvesting way too much, right? I can go back. In other words, you can use your imputed return on capital numbers to tweak what your sales to capital ratio is, so you can end up with a company that you're comfortable with in steady state. Any questions on that imputed number? Yes?
Is depreciation factor?
Because reinvestment is CapEx minus depreciation plus change in working capital plus acquisitions plus R&D capitalized. In a sense, everything that you think of when you do traditional free cash for the firm is factored in. It's almost magical, right? Because it's something you don't even think about, but your reinvestment is driving your future invested capital. Here's the fifth lesson I'm getting from the Amazon valuation. And I talked about this last class. If you look at my Amazon, and let me go back to the original valuation, notice my cash flows are negative for the first 6 years. What am I saying? In fact, I'm explicitly saying that not only do they have to raise capital, but most of it is going to come from equity. You're saying, where am I saying that? But the cost to capital ratios, at least initially, I was 99% equity, 1% debt. I'm implicitly assuming that they will have to raise fresh equity. In other words, I am admitting in this discounted cash flow valuation that there'll be more shares outstanding, far more shares outstanding by the time I get to year 6. Now, normally your reaction is, we need to adjust for that effect. It's going to lower my value per share today. And normally I would say, yes, if you're going to expect to issue more shares, it is less value. But here's the reason I don't have to do it. See this value of 15.2 billion that I got up front? That includes the cash flows from the first 6 years, which are all negative. That value would have been about $20 billion if I didn't have those negative cash flows for the next 6 years. In effect, I'm discounting the value about 25% because I have negative cash flows. That's a dilution effect already captured in. If I now proceed to divide that number by the higher share count I will have because I will have to issue shares, I'm actually double counting the dilution. So I don't know whether you're comfortable with that notion or not, because it is something that I think I still have problems with when people try to adjust for share count, is I think they're double counting. The other big issue with Amazon, of course, was this option overhang, right? There's millions of options the company had given away. But in a sense, I've cleaned up for it. I've cleaned up for it how? By taking the options, valuing them as options. Remember, it's $2.8 billion. And reducing the value of equity in my common shares with the options. So rather than play with the share count, which is an extremely dangerous game to play, try to adjust for whatever you're worried about in your cash flows, in a discounted cash flow valuation, or through the valuation of options, if that's what you're worried about. And you're going to be on much cleaner ground in terms of value per share. Any questions? I talked about failure. Companies fail. Your equity is worth nothing usually. Now, normally when you do a DCF, you're oblivious to failure. Act like every company is going to make it. But we know beyond a doubt that especially with young companies, failure is a real possibility. And that especially with startups, like 2/3, 3/4 of companies fail. And people often ask me, how do I adjust my discounted cash flow valuation for failure? And you know what they normally try, right? What do venture capitalists do? What do venture capitalists claim that their target, if you think about what they claim as the target rate as a discount rate, what do VCs claim as a target rate of return for startups or angel financing? They actually list that on their summary. It's numbers like 50%, 60%. Absurdly high numbers. We know they're lying. You know how we know they're lying? Because if you look at the actual returns made by venture capitalists over the last decade, it's like 13 to 14%. It's like 1% higher than what you'd have made investing in the S&P 500. I'm not saying it's good or bad, but I'm saying that 60% they claim as a target rate of return is clearly not showing up if you look at their realized returns. And the reason is simple. They're demanding 60% because they're saying 3/4 of what you invest in never makes it. They're trying to adjust into the required return this fear that companies will not make it. And it's a very dangerous game because discount rates are blunt instruments. They were never designed for this kind of thing. So you're saying, what choice do I have? Well, if you factor in the likelihood of probability, and this is an updated table, let's say there's a 30% chance that Amazon will not make it in 2000, and I was just oblivious to it. My discounted cash flow valuation reflects none of that worry, right? Because I've used a operating cost of capital, cash flows, terminal value, come up with the value of 15 billion. The 30% of the time that Amazon doesn't make it, what do you think your equity is going to be worth? They shut down, they're going to have a liquidation sale, right? What are they selling? At least in 2000, there was nothing to sell. I can almost guarantee you that if there's a liquidation of a young startup, your equity is going to be worth nothing. So 70% of the time, my equity is worth 15 billion. The remaining 30% of the time, my equity is worth nothing. My expected value then will be a weighted average. I factored in failure through a different process than trying to adjust cash flows and discount rates. Much more effective way of dealing with failures than trying to pump up the discount rate for all the things you're worried about. I tell people, look, discount rate is not a place where it's not a receptacle for all your fears and hopes, because that's what people do. I'm getting scared, let me raise the discount rate. Discount rates are blunt instruments designed to capture operating risk. If you're worried about other risks, they've got to be somewhere else in this process. So I finished my Amazon valuation. This is back in 2000. I come up with the value of 35, stocks trading at 84. And somebody in the audience, somebody probably owned Amazon in their portfolio, asked a very plaintive question. They said, is it possible that Amazon is worth $84 per share? Is it possible? What's the answer to that question? Possible is such a weak word. Of course it's possible. And in fact, I can tell you what needs to happen for Amazon to be worth $84. And this is the advantage of keeping your valuations simple, because I have only three drivers: revenue growth, margins, and sales to capital. And it's really revenue growth and margins for young companies. I said, let me look at the combination of revenue growth and margins you will need to get to $84 per share. So I took my inputs and I changed the revenue growth rate. Remember, I used 42% all the way up to 60%. And a compounded revenue growth of 60% will deliver revenues of about $150 billion. I will make Amazon, but it's possible, right? Maybe Amazon can become the second largest retailer. I also allowed for the fact that my base margin was 10%, but I could be wrong. It could be higher or lower. And I computed the value per share under each of the combinations. It's a break-even table. Break-even and what's in, see these yellow cells? Those are all the values per share that exceed the $84. Those are the combinations I will need for the company to be worth more than what it's trading for. So what do I need? I need either a combination of 60% revenue growth and 8% margins, which means the company's got to grow at to be 3 times bigger than or actually 4 times bigger than I thought it was going to. Then it can settle for lower margins, 55 and 10, 50 and 14%. These are my break-even points. There's actually a book that I really like called Expectations Investing. I don't know whether any of you read it. It's written by Mike Mabusson and Al Rappaport. And Mike writes some very good stuff. And the entire book is about, rather than value companies and compare to the price, it actually takes the price and backs out whatever you're worried about, implied growth rates, implied margins, and then ask the question, am I comfortable with this implied growth rate? So if I buy Paytm, I need revenues to grow 50% a year. Am I okay with the 50%? Doesn't take that decision away from you. It just reframes the decision. Now, as you go through this process, you make assumptions and you say, I could be wrong, I could be wrong, I could be wrong. I told you I would save you the trouble. You're going to be wrong 100% of the time. Why? Because you're trying to play God. You're trying to estimate things for the future for a company that's still forming. And I also told you why that's okay. You don't have to be right to make money. You just have to be less wrong than everybody else. It brings down the degree of worry you have. So don't beat yourself up when you value on companies. I've got to get it right. I've got to get it right. You're never going to get it right. All you can do is make your best judgment, your best estimate with what you know about the company today. Just to illustrate my point about you don't have to be right to make money, when I valued Amazon in 2000, it was hopelessly overvalued. So I told you what I did. I didn't sell short because I was scared. And if I had it, I made a lot of money because by the next year, the stock, the dot-com boom had bust. The stock had gone from $84 down to $11. I revalued Amazon in January 2001. The value that I got was $20 per share. You think that's terrible. Your value per share went from $35 per share to $20 per share. If you think I've changed my mind by going from 35 to 20, what would you describe the market as doing from going from 84 down to $11? But in a sense, in 2001, I was trapped. Trapped in what sense? In 2000, I could do this dance, oh, hey, you can't sell short, liquidity is not there. 2001, you know what the question was, right? It was much more frontal question of, hey, you've got the value of 20, the stock's at 11, are you buying? Bought Amazon for the first time in 2001. Remember the old adage about just buy a company and forget it? In hindsight, I probably should have bought Amazon and forgotten about it. But that goes counter to the notion that you buy something when it's cheap, because if you buy into that notion, what's the flip side of it? You should sell it when it gets expensive, right? So every year since, and after 2001, I revalued. In 2002, I revalued it. My value went up by about 30 or 40%. It'd been a good year for Amazon. It survived. It was now one of the few survivors. The price went up as well, but it was still undervalued. What does that mean? I left it in my portfolio. 2003, I revalued. Great year for Amazon. Stock value, the value went up close to $35 again. Well, actually more than that, closer to 40. And the stock price went up to more than 50 something dollars. Everything's moving in the right direction, but the stock has gone from being undervalued to overvalued. So I had to sell. I had to sell because my philosophy is to buy something that's cheap. It's now become too expensive. So that was my first in and out experience with Amazon. I've had multiple since, I don't know, 2007 through 2000. So each time I bought and I sold. And for a long time, I've been out of Amazon. It's been one of those things that I said, I wish I'd bought the stock or held the stock. And in 2014, I actually stopped and compared. Remember in 2000, with a lot of hubris, I forecast out what Amazon would do over the next 10 years. I very seldom do this because it's actually extremely depressing to compare your forecasted numbers to the actual numbers to realize how wrong you were. But once in a while, you stop and do it just to bring some humility back to the process. In 2014, I look back at my Amazon forecast and say, what did I get wrong in 2000? Nothing I can do to fix it. So what you see here is my 2000 forecast of revenues and what the actual revenues were. I'd forecast that revenues would go up to about 51.5 billion in 2014. They actually ended up at 85 billion. What has Amazon taught me? That my revenue story was too small. My growth story was too small. In my 2014 story, I expected Amazon to make a 10% margin and $5.1 billion in operating income. They actually were making 97 million in operating income and a margin close to zero. Over the 14 years, they've grown much faster than I thought they would, but they seem to be nowhere on the pathway to margins that I thought they were on. Now, normally, this is not good news. You're growing, you can't figure out how to make money. But over those 14 years, Amazon kind of changed itself as a company, right? In 2000, there was no doubt what Amazon was. It was a retail company. I still remember somebody in, like 2 years ago asking me when I showed them the 2000 valuation, why didn't you build in the cloud business? I said in 2000, the only clouds I was thinking about were in the sky. I didn't have any insight that there was going to be a business called the cloud business. You can't have the benefit of hindsight, but clearly Amazon had kind of reoriented. What I was expecting was a company that grew, that Amazon would get bigger as a retail company, then move towards maturity, which is try to get established margins. But somewhere around 2010, 11, Amazon, at least in my perspective, changed their story. Rather than being an online retail company, they seemed to decide that they were going to be a disruption machine. Let me explain what I mean by a disruption machine. They basically said, we're not interested in just dominating the retail business. We're going to go after any business with soft spots and to try to take over the business or try to get a big share of the business. And that means basically they reinvent this. I'm a great believer in corporate life cycles where companies age. Amazon is one of those few companies that seems to have figured out at every stage, how do I, it's like, what's that movie with where somebody gets younger over time rather than older? Benjamin Button, like think of them as the Benjamin Button of corporates. Now figuring out every time they find some new way to rediscover youth, which means some bad things. They reinvest like a young company, they have low margins like a young company, but they recreate this growth rate. It's a disruption machine. Now, one of the most fascinating surveys I saw, asked the 50 largest companies in the world. They asked their CEOs, list the 5 companies that you worry about the most as potential competition. Very different companies, ranging from JP Morgan to, to Disney. 47 out of the 50 companies listed Amazon as a potential competitor. Walmart, obviously, right? Because Amazon lives in Walmart's head. So there's no place to run. FedEx, logistics business. You're saying, why JP Morgan? Let's face it, if you think about the target for a disruption platform, it's any business that's inefficiently run with lots of weak spots. And banking, traditional financial services is like a fat cow waiting to be slaughtered. And I'm sure for Jamie Dimon, your nightmare scenario would be a true Amazon bank that came after your customers. It's a disruption machine. It's the most. So it's, for me, as a company, it's the most challenging of all companies to value, because what's the potential total market for a disruption machine? You could be everything to everybody. It could be trillions of dollars. And it's a disruption machine with an army. You know what the army for Amazon is? When they bought Whole Foods, they're entering into this grocery business, right? Low margin business. The day after they bought Whole Foods, I got an email from Amazon. I wasn't special. About 100 million other people got emails. You know that list of 100 million, right? Every Amazon Prime member. And they said, would you like your meals delivered frozen from your local Whole Foods? Because Whole Foods, 500 stores in some of the most lucrative zip codes in the country in terms of income levels of people living there. You know what happened to Blue Apron the day Amazon bought Whole Foods? It dropped in market cap by 70%. They've got an army. It's called the Prime. It's called Amazon Prime. And they can turn it loose on any business because they've spent 20 years cultivating me and other Prime members to trust them, right? No matter what you think about Jeff Bezos and all, if you want something delivered tomorrow, the only place you go is Amazon. Nobody else can deliver with the kind of promise that they did. And if you don't like it, you can deliver, return it the day after. It's, in hindsight, if you look at it, Amazon Prime was a huge cost to Amazon for the first 7, 8, 9, 10 years, the shipping subsidies. And people say, why are they doing something like this? I don't know whether they were thinking about this right from the beginning, but they now have a disruption army. Every business they go into, Amazon Prime members are the first people they go to build their entry into that business. Yes?
So for Amazon specifically, and other companies, right? But Amazon specifically, they doing off AWS, which is like a regulatory thing that you hear about it once in a while. Is there a way to feed in from a valuation perspective, like antitrust issues, like maybe tapping?
Yeah, in fact, I think the only thing that can stop Amazon now, I'm convinced that no company can go head to head with Amazon long-term and win, because patience is built into Amazon's DNA. The only thing that can stop Amazon now is the fact that everybody will gang up on them. And guess where they go to ask for relief? They might not do it directly, but they're going to the governments and regulators. You got to stop these guys. They're going to ruin the world. They've got a receptive audience, right? Because the one thing that Amazon has done badly is create friendships among regulators and politicians. So I agree with you. That is my biggest risk. If that risk didn't exist, I'd probably give Amazon a 30% higher value than I do. The restraint almost has to be self-restraint. There are things they cannot do, not because they can't make money, but because they're afraid that it'll trigger the regulatory. So I've been more conservative than perhaps I should be in my forecast of growth and margins because of that. But the problem is it's actually very difficult to think of how you regulate. I mean, people talk about antitrust laws. You know why they don't work with the Amazons and tech companies? What was the original basis for antitrust laws? Monopolies, right? And why were people all gathered together when you stop monopolies? Because monopolies charge these high prices, they exploited consumers. Do you feel exploited as an Amazon Prime member paying $119 a year? I think I get one of the most incredible bargains on the face of the earth at $119 a year. Can you imagine as a government saying, we're going to crack down on Amazon. We're going to make sure they don't do stuff like give Prime away for $119 a year. That's 120 million votes you're losing in the next election right there. It's easier said than done because they've cultivated a base that is incredibly loyal and given them stuff for way below cost. And it makes it much more difficult than think of a way in which government can step in and restrain Amazon without, in a sense, pissing off a lot of people. So disruption platform, much bigger. So I tried to value them with a disruption platform. The first time I did it, they were actually overvalued. This was like 3 years ago. But in September of 2020, I revalued them. Now, much bigger platform. COVID, in fact, supercharged that platform because they were now in places they never expected to be. The value I got was about $2,800 per share, which actually stayed, my most 6 weeks ago when I valued Amazon, around $2,800 per share. Stock had dropped to $2,500. Amazon's back in my portfolio. So in a sense, you can see how companies can come and go. The price can change, the value can change. Don't give up on a company because you find it overvalued. So if you picked a company you were really interested in, you find it overvalued in May when you turn in your project, hey, you've done 90% of the groundwork to come back to value the company. Keep revisiting valuations. What's overvalued today could become undervalued tomorrow. And what's undervalued tomorrow can become overvalued again. This is a dynamic game, but both the price and the value are changing. Yes? It's tough, right? Because in a sense, it's an optionality, right? If it's an expected change, you can bring it in. I mean, take Facebook. Right now, it's almost all advertising. But if you think about it, you have 2.9 billion people in your platform spending about an hour every day on that platform, on Instagram and WhatsApp. Are there other things that Facebook could do? Yeah, sure, right? Forget about the metaverse. They could sell you news, they could sell you entertainment, because they have you. Time is the most, having somebody on your platform for that extended time, that's an insanely powerful weapon to have. When I valued Facebook, I valued primarily as an advertising company. As an advertising company, it's already 20% undervalued. So the way I think about it? If I buy Facebook, everything else is icing. I'm going to get more stuff. Even if we're fairly valued, I would buy Facebook. I bought it on Cambridge Analytica. It looks close to fairly valued. I bought it. Normally, you wouldn't buy fairly valued companies because you're saying, what's the upside? The upside here is they have a platform, but they haven't figured out yet how to make other types of revenues yet without pissing you off. But one of these days they will. So if you have WhatsApp and you say nothing's happened yet, nothing's happened yet, nothing's happened yet, something is going to happen. There's no way Facebook leaves this immensely powerful platform unmonetized. So think of this, when we talk about options, this is one of those options we'll talk about, the option to expand. You can't bring it into a traditional DCF, but think of it as a premium on your DCF because of what the company can do. Yes? For my base valuation, revenue growth margin, what non-financial service business cannot be captured with growth, margins, and reinvestment? Or you could break it down by different business. The only problem there is informational, right? sum of the parts valuation, you can do that with any company, but you then need the information broken down by business. Amazon right now breaks down its revenues by AWS and retail and entertainment, but it doesn't break down the rest of the details you will need. So with every company, that's always a choice. You can do it as a sum of the parts, but the sum of the parts, it's not a question of can we do it? Of course we can do it. It's whether we have the information to be able to value the different parts. Okay. I did value Amazon Prime alone as a standalone. It was fascinating exercise because you're valuing a platform. Okay. And there are costs to Amazon, and it's actually explicit. If you go to the Amazon's income statement or 10K, in the footnotes, they actually tell you how much money they spend on shipping subsidies. It's about $18–20 billion. Because with Amazon Prime, you get everything free. That's a lot of money to spend, right? So if you think about why they're doing it, a typical Prime member spends 2.5 times more on Amazon than a non-Prime member. So think about the incremental revenue. So even if you count Prime as a standalone platform, you take the shipping subsidies and how much people, it's close to breaking even. And that's not counting all of the other stuff that Amazon can do with Prime, like turn you loose on any disruption that they do. So it takes a little imagination, but it's, you can bring it into the process. And you're never going to be right. You got to do second takes and third takes to get it right. But leave open that door because many businesses, that's what you're paying for, the chance that the company will change. Now, let's talk about mature companies. Normally, mature companies are easy to value, right? Because they have a long history. They've been doing the same thing over and over again, like we all have. Let me ask you a question, though. We all have routines. We get up, we go to the same coffee shop every morning. We get the same type of coffee every morning. We take the same pathway to school. But are some of the things we do every day kind of bad habits that we probably shouldn't be doing? Absolutely. Mature companies do the same thing because that's what's worked for them in the past. But sometimes those things have stopped working, but they keep doing them. And that's when they get targeted by activist investors saying you need to change. You notice Kohl's is now on the target list because people want the company to change. You're saying, so what? When you're investing in a company which could change, in this case, change its business model, change the way it's run, it's very difficult to do one valuation that captures both possibilities, right? That it continues to be run the way it is, or it could change. So I'm going to give you, again, a very simple way to do this that doesn't require you to bring it all into one number. So if you think about what's causing the problem here, if you think about the 4 questions, what are the cash flows from existing assets? What's the value of growth? How risky are you? When will you be a mature company? The answers to those questions can be very different depending on whether they stay with the status quo or they decide to change the way they run. So I'm going to actually value the company twice. Once with the status quo, with the existing practices, and once with the changes in place. So to illustrate this, I'm going to use a company that some of you might have heard of called Hormel Foods. Heard of Hormel? You know what the most famous product is? Or infamous product? This absolutely disgusting concoction called Spam. You know what makes it disgusting? It's like ham, slimy ham in a can with a shelf life that I think can outlast a nuclear war. How you put meat in a can and it can last forever, I have no idea, but I have no desire to eat it. But there are parts of the world where Spam is very popular. Hawaii. You know why Spam is popular in Hawaii? Because after the Second World War, when the US was trying to bring its troops back from Japan, at that time, they didn't have any military aircraft that could make it all the way from Japan to the West Coast. So Hawaii, if you look at the geography, is right in the middle. So these troops would land in Hawaii for like weeks. And you have American troops coming back from the Second World War. These were not vegan troops. They wanted meat. And the problem was there was no meat in Hawaii to feed all these troops. So the US Army put out this all points bulletin. We need a way to feed our troops who land in Hawaii. We need to feed them meat. And Hormel came up with Spam. So with that long lead-in, Hormel now has a long history. They have all these products, big brand names. But it's a very conservatively run company. It used to be a family-run company, like Hershey's was. It was very conservative. Conservative in what sense? It's a company that seems to think the world ends in the US. Basically, they were not interested in global growth. They just went with US growth, which meant that they reinvested little. They had a slow growth rate because they were dealing with a mature market. And they were also conservative in how much debt they used. Their debt ratio was close to 10%. So basically, they're running the company conservative, not growing very fast, low debt ratio, therefore a higher cost of capital than they did. So my initial valuation, I valued them assuming the status quo: low reinvestment, low growth, high cost of capital. The value per share that I got was $31.91. Boring, conservative company. But even these family-run, boring, conservative food processing companies are now becoming the targets for change. And at the time that I did this valuation, there was talk of activist investors pushing Hormel to be more, go for more growth geographically, try to get, I don't know, Asians to eat spam, and also use more debt. So I said, what would happen if the company became more aggressively run? And I assumed a higher reinvestment rate, a higher growth rate, because you're reinvesting more. And also that they would use a lot more debt in their capital, not crazy amounts of debt, but enough debt to lower their cost of capital. Higher growth, lower cost of capital. No surprise, the value per share that I get is $37.80. So I have two values, right? $31.91 and $37.80. Let's say the stock's actually trading at 33. Do you see the kind of challenge you face? 33 is higher than the $31.91. So it looks expensive, but it's lower than what the company could be worth restructured. But I'm not going to do the one hand or the other hand. That's kind of waste of time. So here's the final piece I brought in. I estimated a likelihood that change would happen. It was very small. You say, how do you estimate the probability? Here are the things I looked at. For change to happen, somebody's got to put pressure, then enough shares have to vote with you. So I looked at the largest shareholders in Hormel. And the largest single shareholder with a 23% holding, I think, was the Hormel Foundation. The Hormel Foundation was the old family money invested in a foundation, and they own 23%. So I said, who controls the Hormel Foundation? Who runs it? Obviously, the family runs it, but they're all too busy living off the wealth. None of them is actively involved. So I looked at the chair of the foundation. And the chair of the foundation had the same name as the CEO of Hormel. It's actually the same guy. And I said, this is not good news for change. He's the chair of the foundation, that's the largest shareholder, he's the CEO of the company. Now do you see why this assessment of probability is going to be very much a function? You look at that, if you see Carl Icahn on that list, that probability of change probably just went up by 25% overnight. Normally in valuation, we don't think of things like who owns shares in the company. But in cases like this, it can make a big difference in how much you're willing to pay, because I attached a 10% chance of change, and I came up with an expected value of $32.50 that was lower than the price still. But as I said, if tomorrow Carl Icahn bought shares in the company, my values don't have to change, but the probability very quickly can go from 10% chance of change to a 25% chance of change. So use that power more essentially I've done two valuations under two scenarios and taken the expected value. Now, of course, when you look at these mature companies that are targeted for change, all the easy buzzwords come in, right? What's the first one? There's going to be a lot of cost cutting at the company. It always sounds like a good thing. So one of the interesting questions about cost cutting is there's a lot of talk about cost cutting when you see these companies restructuring. So restructuring, cost cutting is there. But does it really happen? And the answer is, well, it depends first on how much buy-in there is to the cost cutting. If it's easy to talk about cost cutting, but it's very difficult to actually deliver on cost cuts, because the big cost cuts create pain, not just for the people at the bottom, but at the people at the top. So the easy cost cutting is, let's have 2 janitors instead of 3. Everybody taps each other. Oh, we're so good at cutting costs. Let's have 2 directors instead of 3. Not so easy to make that change because that person sits on the top floor. So McKinsey actually has this study. They look at what are some of the variables that predict when cost cutting actually gets carried through. So these are surveys, so I wouldn't take them too seriously, but they talk about how much there's got to be true buy-in from the top management for cost cuts to happen. So just as a general rule, don't take the cost cuts that are stated in a news release as reality, build them into your valuation, because a lot of the time they don't get delivered. Second, a lot of these mature companies, they get targeted saying grow faster. In the case of Hormel, that made sense. Why? Because they were earning more than their cost of capital. But if you have a mature company that's struggling to make its cost of capital, the last thing I want them to do is to try to grow faster. You've seen this updated version of the graph, but when I valued Hormel, I had that graph of what percentage of companies globally earn more than their cost of capital, roughly the cost of capital, and below the cost of capital. In the case of Hormel, they were on the right side of the divide, but if you have a company on the wrong side of the divide, the best scenario for you is that this company grows less, actually shrinks over time, not necessarily grow. And finally, just as a review of your corporate finance, when I changed my debt ratio from 10% to, I think I moved to a 40% debt ratio, I think. Yeah, 40% debt ratio. And you're saying, why do you pick 40%? I'd use an industry average, but remember in corporate finance, we talked about the optimal mix of debt and equity for a company. And we came up with the cost of capital at different debt ratios. That's basically what I did. I looked to see where the cost of capital is minimized, around 30 to 40%. And that's what I made as my target. A higher debt ratio by itself doesn't always lower your cost of capital if you're already the correct debt ratio. Hormel happened to be under that. So what worked at Hormel might not work at another company. That's why I can't read from the same script at every company. But if it can work, then you can do these two valuations, see what the expected value is. Any questions on the Hormel valuation? Let's talk about dealing with declining companies. As I said, valuing declining companies is a truly depressing exercise. That's why people don't like to do it. Often when I talk to people who do DCFs all the time, I ask them a question. You can try this out as well. When was the last time you valued a company where you put in a negative revenue growth rate? You know what? There are people who've they've done valuations for 35 years, never once have they used a negative revenue growth rate. I said, does that make sense? I mean, there are companies out there that shrink. How come you never encounter these companies? The answer is they do, but they override the negative and put in a positive because they feel much better about it. But we've got to be reality checked when we value these declining companies. And let's look at why valuation is difficult with declining companies. When I look at your past, I see a depressing past, right? Revenues are shrinking, margins under pressure. When I ask you what's the value of growth, you laugh. What growth? That was 10 years ago. You're beyond mature. When I think about riskiness, two things I'm worried about. You're shrinking, you might be getting out of businesses, your base business risk might be changing. And if you're not careful about paying down your debt as you're shrinking, I'm also worried about, will you make it? You're going to get higher and higher debt ratios over time. And I ask you, when will you be a mature company? You say that was 10 years ago. Now I'm beyond mature. The end game here might be liquidation, not forever. So when you value declining companies, one of the big issues that you have to worry about is this concern that the company will not make it. You value Bed Bath & Beyond. Forever might be a dream. You're asking, will it last 5 years, or 7 years, or 10 years before the company tapers out? So you got to be willing to put in decline in, and you got to factor in the reality that company might not even make it through that period, but there's enough debt. Dealing with distress, just like dealing with failure with a young company, you can't do it through the discounted cash flow valuation. You can't adjust discount rates for distress enough to reflect the chance you will not make it. See, what do? Well, I'll give you an example of a company that I'd value. This is way back in time. The company's still around. A company called, is JCPenney still around? I think they are, right? So this was in 2000 and whatever. Just to show you that you can value companies. So when I value JCPenney, their best days are well behind. So I put in a negative growth rate for the first 5 years. fact, they never come back to great growth. I mean, basically, I'm shrinking the company, making it into a company that could potentially survive, maybe a third of the size or half the size of the existing company. And I'm adjusting margins over time to reflect the fact that there's a core business. That might not be true, but if there's a core business, then you're going to shrink back to that core business. Maybe Bed Bath & Beyond will continue to operate in college towns and big cities, but Bed Bath & Beyond in suburban areas is going to go away. So how do you bring that in? You bring in negative growth, you essentially shrink the company, you improve margins for the remaining parts of the business, and you do a discounted cash flow valuation. The story you're telling is of decline, and you're reflecting that in the revenue growth and margins. But you might have a declining company where the end game is not continuing operation. There might be no core you can come back to. With declining companies, you might stop in year 5 or 10 and just get a liquidation value. Remember, in capital budgeting, there are some projects that don't, it might become a finite life valuation. Now, dealing with distress, as I said, is painful. So here's my suggestion. Just as with Hormel, I did 2 scenarios. Just as with Amazon, I talked about bringing in failure risk in 2000. With distress, here's my suggestion is you value the company twice. The first time, put your optimist hat on. What does the optimist hat allow you to do? It allows you to assume that your declining company with a lot of debt is going to recover and become a healthy company. So in your DCF, you build in improving margins, reducing debt ratios. You fix the problems. You come up with the DCF value. But be very clear, that is your value for the company if it makes it. But don't stop there. Ask yourself 2 follow-up questions. What is the chance my company will not make it? And I'll give you a few suggestions on how you can estimate that chance. And then ask yourself, what will my equity be worth if it doesn't make it? Last step, you got your DCF value times the likelihood you will make it, plus the value of your equity, assuming you don't make it, times the probability of that happening. Your expected value will now reflect distress. So I'll give you an example. This is from February 2009 of a company called Las Vegas Sands, the casino company. Casino companies tend to have a couple of characteristics that they share in common. First is their projects are hugely capital intensive. If you ever gone to Vegas and you walk by one of those casinos, it's a huge infrastructure investment. That's the first feature. The second is they tend to be run by megalomaniacs. Think about any casino company, who runs it? Wind Resorts, Steve. I mean, basically every casino company I've ever run into is run by a megalomaniac. Both those parts are going to come into play when I talk about Las Vegas Sands. Las Vegas Sands was one of the fastest growing casino companies of the 2000s. They started as a Vegas casino, and then they built casinos in the US, and then they built in Macau, and then in Singapore. If you've ever been by Marina Bay Sands in Singapore, there's like this big boat on top of this 30-story building. Huge infrastructure investments. You think, so what? How do you think they fund these investments? Usually, you can fund it with both debt and equity, right? But they funded them predominantly with debt. You think, why? I'll give away a secret here. No, it's not a secret. If you look, even if you even took a quick look at the numbers, Las Vegas Sands was controlled and run by a man called Sheldon Adelson. You heard of him? No. He owned 52% of Las Vegas Sands equity. He valued control. Now, do you see why when casino companies fund projects, they fund them almost entirely with debt? Because if you issue equity, that's going to risk losing control. So they used debt, pumped up the debt ratio. And when times were good, people celebrated. Las Vegas Sands was one of the most highly recommended casino companies, 2003, 2004, 2005, growing fast, margins improving. And then 2008 hit, and the bottom fell out of both the business and the debt market. So this was in February 2009. I'm valuing Las Vegas Sands in the midst of rumors that the company would not make it through the next debt payment 6 months from now. So I put my optimist hat on, I ignored the rumors, and I fixed the company in my spreadsheet by doing what? Growth came back, margins improved, debt ratios came down. I did a traditional discounted cash flow valuation of a recovering company with terminal value, essentially bailing me out. And I came up with a value per share of $8.12. Stock was trading at $4.25. Your first reaction is, hey, that looks cheap. Why don't you buy it? And that's exactly what somebody asked me in February 2009. I said, I'm not comfortable buying it, which led to some soul searching. If we valued it at $8.12 and the stock is trading at $4.25, why don't you buy? Well, here's the reason that $8.12 is the value per share if Las Vegas Sands makes it. What are all the rumors swirling around me? That they might not. I haven't brought that in yet. You're saying, isn't it in there in the cost of capital? No, in fact, I'll save you the trouble. There is no way you can bring distress into your cost of capital because the cost of capital is an operating risk measure. And this is a risk that I will not make it. So I was faced with the task of estimating the probability that Las Vegas Sands would not make it. How would I get that? What are some of the ways in which you can estimate the likelihood your company will not make it? If I gave you a rating for your company, would that help you estimate a chance you couldn't make it? Yeah. Yeah, but I have 10 years, right? So in a sense, so they might not capture something that's happened recently, but it doesn't, no, you're right. If it's happened in the last 2 weeks, Burbank, you might not get it. No, but if it's been around and there's risk, there's rating, there's a, Ed Altman, who I don't know whether he still teaches his fixed income class here. Every year would update this table where you take the ratings from 10 years ago and tell you what percentage of bonds within each ratings class failed within 10 years. So if you're AAA, it's like 0.18% of AAA bonds fail within 10 years. Because within the 10 years, the AAA can become something else, but it's very unlikely. With CCC, it's like 51% of bonds fail within 10 years. So one easy way in which you can get the risk is by taking the rating, and there's a lookup table. If you go to my website, where if you tell me what the rating is, I said, chance your company will not make it is like 35%. But like you, I didn't fully trust the rating. So I took a second route. If you have a rating, usually have bonds outstanding, right? Those bonds get traded. I found a Las Vegas Sands bond with 7 years left to maturity that was trading in the marketplace. It's a pretty liquid bond. Now remember, bonds have a par value of $1,000. This bond was trading at $529. So what's the market telling me? The bond market. Chance, a big chance this company will not make it, right? Now, normally, do you know how we price bonds? We take the promised coupons and we discount them back at a risk-adjusted rate. I'm not going to do that. I'm going to take the expected coupons. You're saying, what's an expected coupon? The bond might make a promise, but for that promise to be delivered, the company's got to be around. So I took the promised coupons and I multiplied it by this probability that the company would. I don't know what that probability is, so think of it as this X variable I put in there. So if there's only a 20% chance you'll be around, I'll actually not get the 63.75. I'll get 63.75 times 0.2. So I set up my equation. I know the price. I know the promised coupons. And if I'm adjusting the coupons for the chance you will not make it, I can discount them at the risk-free rate because my cash flows are now risk-adjusted. So I know the price. I know the promised coupon. I have the risk-free rate. What's the only thing I don't know? The only unknown is the chance you will not make it. If you've never used the solver function in Excel, use it. It's actually a very useful function because trying to solve for this mathematically will be trial and error, but I solved for that probability and it terrified the wits out of me. Because if that price is right, the coupons are right, and the risk-free rate is what it is, there was a 77% chance. It's 13% a year, but remember, to survive to year 10, which is what I need to get to nirvana, I've got to do this year after year. There's a 76.6% chance the company will not make it, according to bond market. I am trusting the bond market to get it right, but let's give bond market investors credit. They're fixated on one thing and one thing only, right? Which is, am I going to get paid? Am I going to get paid? They're not like equity investors who get, who think about growth and all this fuzzy stuff. So at least we've got to give them credit for the focus, and this is their only focus. So here's what I have. $8.12 is the value per share if the company makes it. But according to the bond market, that's about 23.3%. The question I had was, what will happen if Las Vegas Sands doesn't make it? Let's play it through. They're not able to make a debt payment. There's going to be a liquidation, right? What do they have to sell? Gigantic casinos. Who are the potential buyers? Other casino companies. And what do they all look like in February 2009? Basket cases. They have no money. If you did a liquidation sale of these casinos, it's unlikely you're going to get the fair value of the real estate or even the value of the casinos. You'd be lucky to get half of book value, a third of book value. And given how much money they owed almost at that point, $8 billion in debt. There's almost zero chance. In fact, let me take the almost. There's zero chance your equity is going to be worth anything in an actual liquidation. But in some companies, there might be some equity value. Here, there's nothing, which means my expected value for Las Vegas Sands is $8.12 times the probability that they will make it, plus nothing times the likelihood of complete failure. My expected value is $1.92. The stock price is trading at $4.25. On a distress adjusted basis, I'm not going there. In fact, during COVID, at the peak of COVID, on March 23rd of 2020, remember, people had given up on stocks. We weren't sure. I valued Boeing. Normally, you don't think about distress at a company like Boeing, right? But my point is distress is something that can show up even in mature companies during periods of crisis. So in my discounted cash flow valuation of Boeing, I did a traditional DCF, assuming that the economy would recover. Boeing, after all, it's a business, it's an oligopoly, right? I mean, you want to buy an aircraft, it's either Boeing or Airbus, that's not going to change. So in my DCF, I put that optimistic view. And then I said, but there is this very real chance, 20%, which is high for a company besides a Boeing, that if this drags on, that the company might not make it. During crises, this failure probability might increase across the board, even for companies that you normally don't think about it. So keep that weapon in your arsenal. And that's part of the reason I've built it into your spreadsheet. I ask you, what's the chance of failure? And most of the time you might say zero, but if you're valuing a young company, a company with a lot of debt, a very cyclical company, use that as your lever to decide, will my company make it? And then I ask you what will happen in liquidation? And I give you choices, right? You can get half a book value, quarter book value, half a fair value. So I give you lots of choices, but that's to assess what your equity will be worth if in fact you hit that wall. So I'm going to stop there. And next session, when we'll start on emerging market companies and talk about the issues they bring to the table. So first 30 minutes of class is quiz on Monday. So please try not to be late. Oh, one more thing. I will give the remote option for those people who either feel uncomfortable or whatever. And I don't even want to put excuses in your mind, but if you really don't want to be physically here, I will put up a Google, just like last time, a Google sheet. Please try to put your names in by Sunday night, because I have to actually physically go in and create that list so that you can take it. So if you put it too close to the class, it's tough to do. So try to get it by Sunday night, but I'll send you all of that information sooner rather than later.
We just think how to make like a quick first, like if you want to, because we have limited time at the end, so you want to
Do you want to find companies that are more likely to find undervaluation or overvaluation? These are pricing, low PE ratio, high margins. So you're looking for mismatches, right? If you just look for low PE ratio stocks, you get a lot of bad companies. But if you look for companies with low PE ratio and high margins, you're more likely to find something in there that could do that. So whenever you screen, you're looking for some mismatches, low price to book, high return, low multiples of revenues, high revenue growth. Called a companion variable. Later, when we talk about pricing, we're going to talk a little bit about how, but that's how you screen if you look for mismatches. Don't just screen for low PE stocks. So usually a list of crap, right? You get maturities, you get negative growth companies that are going to go bankrupt next week. So you want low PE and something like high growth, low price to book, high return active.
And what goes we use?
You can screen for every company, and then you can have geographic constraints. I don't want, because when you're trying to look for low PE, high, low price book, high return equity, you're going to get a lot of Russian companies.
Yeah.
So you might say, look, I want to remove these regions from the world. So capital IQ, you can keep adding constraints to prevent yourself from falling into a trap of being caught up by the company that there's an obvious reason. You want to ignore companies if there's an obvious reason it looks you. A lot of debt, it's in a bad country in terms of risk, it's because terrible returns. You want to find companies where everything looks lined up in terms of this being a good investment, but somehow trading at 6 times.
I was wondering, when you extract the probability of failure from
You probably underestimate probability because I'm assuming it's 0 1. You either get paid or you don't get paid, but then often you get a portion of the payment, right? So when I say your expected cash flow is your promised coupon times the probability, I'm acting as if you don't survive, I get nothing. But the reality, so in that sense, I'm probably overstating the likelihood of failure. And there are ways you can adjust it because the spreadsheet all you have to do is add a percentage claim you're going to get in the order. So you can make this more complex and more realistic. But basically, all I'm saying is the bond price is your best indicator of what bond investors think about the check. In fact, you can even go as far as to use 1-year bonds to get a 1-year probability. Because what you find often with probability of failure is it's not even over time. It's actually very high early on, but if you make it through year 1 or 2, it actually drops off precipitously. So you have companies, a lot of bonds outstanding, you can get the 1-year, 2-year bonds to get the short-term probability, take the 10-year bonds to get the long-term probability. And that might allow you to finesse what it is over time.
I guess maybe then this would have to be separate part of this, but don't you, if you just take the probability for of failure and apply that to the end valuation, isn't some of that already in there from the cost of debt having the
right? And if you worry about this simple fix for it, right?
Yeah.
When you value do a discounted cash flow valuation of troubled firm, use the cost of capital of the industry average cost of capital. Just use that, right? That actually might not be a bad idea because trying to get a cost of capital for a company that's melted down is insanely difficult, right? The debt is through the roof, the equity, the debt to equity ratio is 500%. You do a levered beta, it's like 15. All the numbers look kind of unstable and makes DCF really messy when you have to really. Your cost of capital can change over time, transition.
Right.
But it's actually very difficult to get your cost of capital up. It's easy to get your cost of equity. Pushing your cost of capital up to a level that reflects your peers. It's almost impossible. I mean, imagine valuing square back now, right? You're saying the only tool I have is my cost of capital. There's almost no cost of capital that will give you realistic value because your peer is not about operating risk over time. It's will the Russian government confiscate or nationalize my holdings? So discount rates were never meant for that kind of discrete risk. And when people try to force it in there, and as I said, VCs try to do it. I've seen people valuing biotech companies push up discount rates early in its life. Why? Because there's a chance the drug will not be approved. They're trying to push it in there. It just messes up the process. It creates this arbitrary discount rate. Because often it's completely arbitrary. You put a 25% discount rate, right? So I'm scared. And you end up then, I think it's healthier separating the two. Because to me, what makes for a great VC is not to say really good at valuation, they're really good at assessing failures. In other words, for every 10 companies they start, only 4 fail. If you can do that as a VC, you're going to walk away with immense wins at the end of it. And this then forces you to ask, what can we do to reduce that failure problem? It could be that it's a serial entrepreneur who's done this before, there's a lesson. So implicitly, what you already are bringing in, you now make explicit, and it forces you to go through the data and say, are younger entrepreneurs more likely to fail than older entrepreneurs? Are entrepreneurs who there's actually a study that I saw that entrepreneurs with MBAs have a higher failure rate than entrepreneurs without MBAs because they have other options, right? So things don't work out. They say, you know what, I'm going to go back to what the Goldman Sachs. So there's right now we're not looking at any of this stuff because we don't explicitly think about failure. It's this target rate of return, which is a lazy way from. I worry about a lot of things that we put it in there. And I think on that failure number, I think we'll just scratched the surface. There's so much we can learn by looking at failures over time and assessing what predictors we can use to make it.
I have one other